What up, HyperChange? Welcome to another episode. Today we've got the legendary paper bag investor on the channel to talk everything lemonade. Mr. Paper Bag, how are we doing today?
Hey, Gally. Thanks so much for having me. This is awesome. So good to be here.
Yeah, so you were extremely highly requested in my journey of doing lemonade research. I've been, dabbling with lemonade, bought an eensy weensy amount of stock, trying to learn more about this company, see what the potential is, see if this is really a 100 bagger or 10 bagger or a true kind of disruptor. So I'm super pumped that we get a scheme on this company. Maybe tell us really briefly to start, what is the high level thesis about lemonade that gets you excited? Why is it worth so much of your time and your portfolio?
Yeah, great question. So Lemonade or insurance, it's massive market, like $6 trillion market. I think it's going to grow even bigger as the world becomes wealthier and there's more people. And most insurance companies, the legacy companies, are super old companies. I think they have a lot of cultural debt. It's difficult for them to make drastic changes. It's not even in the best interest of much of their employee base. Maybe it's not even in the skill set of their, executive branches, not even really in the risk appetite of their investors. None of those things. So they're not incentivized to change at all. And then Lemonade is a digital first insurance company that is, in my mind, they're one of the few that's really built with like the much bigger global ambition. There's other sort of pocket insurance companies that are starting up, but they're like, we do this specific product in Florida in this way, and like that's cool and that's their niche. But Lemonade is, in my mind, the only one that's saying, hey, we want to be this global insurance brand. We want to be the Amazon of insurance. And so, and they're building everything inside of that ecosystem in this really thoughtful digital way. And because of that, there's there's two benefits of that. They're pushing towards what they call the autonomous organization. So within that, you're cutting down their costs as much as they possibly can. There's maybe more upfront costs and more engineering, but as they scale, we should see the benefits and fruits of that, where you can say, hey, we can 10x our premiums and not hire any more people on the customer service side because it's all handled completely autonomously. And then also inside of that sort of purely digital system, you can be super measurable. So you can say, you can say this person, all these different attributes or characteristics of this person, or how they read the fine print or don't, or they're really on top of paying their bill promptly, or they're really slow at paying, etc. Like, you're going to tell us, we're going to feed that into some, an AI, or track or calculate the risk, underwrite the risk better around those customers to say, look, these people are safer customers and deserve better rates. These people are worse customers and kind of more risky people. So you get those two kind of benefits, big benefits from the digital, this like really digital structure. Of course, there's other benefits too, like you can expand globally faster because there's no brick and mortar shops and you have things like that, right? And then the benefit of that, part of the thesis is you have a net promoter score of something like 70 or 70 plus. So people love the product because you don't have to wait on hold. You can just like go into the app and it makes sense and make changes to your policy, in a matter of minutes and understand what you're doing. And it also, part of that is that you're attracting younger customers then. Of course, like younger customers are going to prefer kind of an app and that a purely digital ecosystem to understand that better, more likely. And then within that, because of that efficiency, your they can really dominate in the unloved, underserved products, especially renters insurance, pet insurance. So other insurance companies, I don't really care as much about renters insurance, pet insurance. Even people I've sort of pitched this to scoff and say, like, who cares about pet insurance? But they're underserved products because the premiums are much lower. And so another legacy insurance company might say, like, why why do I even want renter's insurance? It's just a headache. And like somebody's laptop was stolen or got damaged and it costs $500 to, replace it. And now I maybe have to spend $500 of my employee's time just to see whether whether this is fraud or not. Like it's like those kind of claims. They're saying this is just a pain. We don't even want these little premiums. But Lemonade, because everything's so digital, they're really trying to push for this autonomous organization. They can really dominate in terms of pricing, still have really healthy loss ratios in those products. And then the idea is they're going to really own those product markets, take those customers in. Those customers know and love Lemonade. Then as they get bigger products, like especially cars, one that's coming, as customers jump to that and they become wealthier and they become older and they may have multiple vehicles, well, they're going to more likely choose car insurance. Even with that, Lemonade has a history with those people and they can say, hey, Gally here, he's super thoughtful. He pays his like Tesla Model Y insurance on time every time, or like his like renter's insurance or home insurance or pet insurance or whatever. And now, like 5 years later, like we can offer him the very best rate, better than anybody, and for his car. And we know like the data shows he's a thoughtful person and he deserves this better rate, and we'll still make a great profit margin on it. So that's kind of the thesis in a few minutes. And it's just like this ginormous market, like, multi-trillion, 6 trillion, and it's going to grow market. And they're just this tiny, like they have, 1.1 billion in premiums. So yeah.
Yeah. And they're only like a $4.5 billion market cap right now, which is one reason I got so interested is I was like, they seem to be crushing it. They have huge potential. They're still really small.
Yeah.
So could you walk us through a little bit about who started the company, who's the owner, operator, founder behind Lemonade, what you think of the management team that's going to be able to pull this off, and then what business lines did they create to get to where they are today? Like, are they all pet and renters insurance right now, 50-50 moving into car, or like what's kind of the arc of their business?
Yeah, for sure. So there's two co-founders. There's Daniel Schreiber and then Shai Wininger, and they're both kind of out. They've had different titles, co-CEO or president, CEO, whatever. But Daniel's the sort of the speaker, the voice. Um, you rarely see Shai in an interview. He had a few like long ago. But both, I mean, I've talked to both, I've interviewed both. Shai just doesn't want to be on camera for whatever reason. He's like the hardcore engineer. But I can tell you at investor days, like he commands the room and has the respect of everybody. He's extremely sharp. And I think a lot of the like detailed vision of like exactly how we're going to implement AI in these different ways and attracting the right talent to do that. It comes from Shai, and then a lot of um, the other sort of voice and speaking that vision out, I think comes from Daniel. So I don't know. My experience with both of them is they're extremely sharp. If you listen to, interviews with Daniel, or there's some old ones with Shai. He's actually a great speaker too. He should do more interviews. And I mean, my experience at both investor days too, and we both investor days, there was like they love the retail presence and retail investor voice. They've told us that they organized like drinks with the retail investors after both investor days. So we got to talk with management there and just hang out with
Love
them.
that.
And yeah, they're super. I don't know. There's in my mind. I mean, I don't know how you sort of quantify that, but in my mind, they're super super sharp team. And then sorry, what was next in your question? You asked.
Kind
Oh
of the
yeah, the
business arc of the
products.
business. Like, what do they
Yeah,
start with? What are they in now?
yeah. So they started mostly with renters insurance, and that's continued to grow. It was a few years ago now. They launched pet insurance. Pet insurance has been growing significantly. Like it's growing like in the 50 some percent year over year in terms of
I
premiums.
love that. You made a joke earlier about like who likes pet insurance. I'm like, I love pet insurance. Like the trend of people getting more pets, caring more about them is a
Yes,
huge trend to tap into.
people don't. I remember I was on like that's how you say his name, Amit's investing. This
Oh
was
yeah,
like
yeah,
a
yeah.
few months ago, and I tried to pitch pet, and I feel like he didn't really understand or like grasp it, and that's totally fine. But like, because I think a lot of people are just like, what's the big deal, pet insurance? But I mean, pet insurance is huge because just like you said, that as the world becomes wealthier, the trend is people tend to have less children, more pets, and they care about their pets more. So it's like pet insurance is only like $5 billion market in the US right now, let alone the whole world, but just US wise. And it's like it could grow to like easily, I think it's growing like 25% a year or so, the whole market in the US with
Wow.
tiny penetration in the US. But just the market's growing at that rate, let alone Lemonade's growing to like 57 or 50 some percent year over year in pet insurance themselves. So pet also, just to plug that too, it's really like critical for Lemonade because they call it's the claims side of things are high frequency, low severity claims. So you learn a lot around the customer because people use the product. They're like, oh my, I went to the vet and I had an $80 bill and I submit the claim. Like other insurers hate those products because it's a ton of administration. But Lemonade, because of the autonomous sort of push that they have, they love, they love those products because it's like we can handle them all and nobody else can. Anyway, so that's they're in pet. They do have home insurance. They cut back. There was a problem with home insurance. I think that was a mistake you could say they made,
Hmm.
where they pushed too hard into home insurance. But they also were kind of like at the mercy of the market. Like at that time they didn't know that, um, or COVID came and and then record inflation came. So as an insurance company, you're pricing your products based on what you think it's going to cost to, say, replace someone's home, but then the costs of all those materials in the building and the labor, et cetera, shoots up. It's like, shoot, now you're in a pickle. So they've had to non-renew a lot of home, where that means they're discerning and saying, look, this customer, we're just not going to be profitable. We don't want this customer, so we're going to cancel them. Um, or increase their rates dramatically. There's also like issues with home. I think it's more regulated in how you you can't just change your pricing dynamically as at wherever you want. You have to go through a process of approvals with your state regulator. So,
Hmm.
um, anyway, so I think home will still be like an important add-on product. Will it be like as good or juicy a margins as a pet insurance product or renter's insurance or even their car? Probably not, but it's still something they're going to provide, and go with long forward. They also have some life insurance that it's like a tiny, tiny, tiny amount. So there hasn't been much push into that. But again, as their customer base gets older, more people have more families and they tend to sign up for life insurance. That could be, market that grows. But yeah.
Gotcha. And so, how do we analyze and break down an insurance company, like really simply? Because that's something that I've struggled with is how to do fundamental due diligence on them. Like, I'm looking at their financial statements. They've got like, and one thing that attracted me to Lemonade is just consistent revenue growth. Like, we've seen them compound revenue per share go from like 20 million in revenue in 2019 to like 600 in the past trailing 12 months. So they've and this is one of my favorite trends, like winners win. Like you
Mm.
can talk all you want about the story of Lemonade, but it's like they're putting up the numbers to prove it. Like what other insurance companies up from like 20 mil to 600 mil, like entering all these new markets, positive net promoter score. So it seems like the business has a lot of momentum, but I'm struggling with understanding how to break down that momentum. So can you help us with how do you think about the valuation of Lemonade and what metrics to follow?
Yeah, I can kind of give like a quick overview of how I think about the mechanics of the financials
Yeah, yeah.
and sort of how that will funnel back into growth and profitability. Okay, so you have a certain amount of premium, or they call it in-force premium, which is just like all the dollars people are giving you for their policies. And then Lemonade has a certain amount that goes to reinsurance. It's just a way for them to basically they're insuring another insurance company, larger one they're bringing in to take a portion of their risk in case of sort of massive catastrophe. So limiting those sort of major downside risks of something crazy happening. So you pay some cost there. As part of that reinsurance. I mean, if your loss ratios were really high, you could actually have a benefit where you're being paid back more. Essentially, your insurance is paying you back. But there's some costs factored in there out of your premiums. And then you have your loss ratio, which is just how much dollars you are paying out in claims and also the administration of those claims. So if you have a 70% loss ratio, you're seven out of every $10 is paying out claims. So, and then you have $3 left for profit and the operations of the business. So all that leftover after that, I think about it for Lemonade really only in two factors, two sort of categories. You can like break it down in detail, of course, but you can think about it in how much they're spending on growth and they released they okay I'll keep going then I'll back up a bit. So how much they're spending on growth or in sort of their marketing, the actual advertising spend of your sales and marketing, and then how much you're spending on all of the other operating expenses, so your tech development, your G&A, everything else. You could kind of lump everything else together, and they hinted or sort of suggested at their last investor day that that might grow like 5% a year. So everything else, all your sort of
Mm.
overhead, maybe that grows 5% a year. But then the biggest part of your operating expenses is your growth spend. And that's a portion. The way they like release the numbers, I don't think they used to do this. And then I think they realized like this was a better and clearer way to do this. They put it in their letters or in their earnings calls. They'll tell you what portion was used as growth spend of your sales and marketing. So the other portion of sales and marketing I kind of call fixed. It's basically hasn't it's not changing that much. It's like 10 million a quarter or something, like as sort of your overhead is part of your other overhead. And but then the portion of your the growth spend portion, you can that's a significant portion, and that's really important to track. And you can look backwards and say how much premium are you bringing in for every dollar you're spending on growth, and that's something I'm tracking and forecasting. And then you can project that out into the future and say, hey, if your top line is going to grow 30% every year for the next 8 years or 9 years, that's what they suggested at Investor Day. So they go from 1 billion to 10 billion. Like how much growth spend are you going to be needing to spend to make that growth happen, as well as overcome customers that churn away or you have to non-renew, those kind of things. So that's your premium. There's some premium that's leaving, it's churning, and then all your premium that's coming in, you're spending. Your big part of your spend is your growth spend to make that happen. But then out below that is, within that is your how efficient are you in your pricing and your underwriting risk selection that will affect your loss ratio. And then below all that is all the other operating expenses, which if the autonomous, organization theory is true, then you should see like tremendous operating leverage on that portion, which again, I'm modeling that at yeah, 5% growth. So if you do all that, you look where earnings could go, over the next as they approach, because they're sort of their goal with investor at the investor day was that they're going to go from 1 billion to 10 billion. And I think it was kind of suggested as like 30% compound ended annual growth. So it's sort of like 8, 9 years to get there. If you look out that far or even a little bit further or whatever, then discount back, it's like you can make the argument they're worth $100 to $200 a share. Probably would be what I would suggest. It's sort of like, and we've been saying that since they were $16 a share. It's like they're worth probably $100 a share plus. So, I don't know. That's sort of a big framework, bit of an idea without digging up all the numbers. We could do that another time or watch my videos, but yeah,
So, okay, no, that's super helpful. So the three numbers I'm looking at, which they seem to be the
yes,
most important North Stars in their shareholder reports and stuff, are customers,
yep,
premium per customer,
sure,
in-force premium. So
yeah.
we got 24% year-over-year customer growth, 4% year-over-year premium growth, 29% year-over-year in-force premium growth. So what am I looking at with these numbers? What is the in-force premiums? Because that seems to be like the most important number.
In force, the way they define it, that's your premiums that are like are that they've took in at any point in time. So if you added, if you went out and bought a car policy, the next, like if they were tracking it on their internally, it would show in-force premium jumped, whatever, $2,000, whatever the policy is. Um, I think it's on an annualized basis. So even if you bought renter's insurance, yeah, it'd be on an annual. Even if you bought, you're paying monthly for renters and you could cancel anytime, it would be that on it. It would show on an annualized basis. And then you call it earned premium is they'll talk about gross earned premium or earned premium
Looking at
is
that now. Yeah.
when when those policies turn over. So at the end of like by the end of Q3 that's coming up, they'll say, look, all of these policies in the last 3 months turned over, like we're done. We earned that premium that we've held for maybe the last month or last 6 months or year, and now it's become earned premium. Like it's roughly like a quarter of your in-force premium, or a little bit less than that because the top line's growing. So it's sort of a trailing, it's more of a trailing metric, while the in-force premium is a current metric. But and then the other things like premium per customer, well, customer count, just how many customers at any given time, and then premium per customer. Um, Obviously your average premium per customer. You can note on premium per customer, like they're only what it's $402 per customer right now. And I forget it. I forget the numbers offhand, but the average insurer in the US, it's way higher. Is it 1,600 or like 2,000? Like it's like something like in that ballpark range, your average premium per average customer. So idea is that number is going to continue to rise as your customer base grows, expands. I think it's going to probably for a long time stay lower than the average because they're going to keep expanding. Like they're not going to stop. Like they'll go, hey, we're in Canada. Hey, we have more products in these parts of Europe, right? So you're always kind of pushing that the next youngest customers. You're always going to have a sort of lower average until like way down the line when you reach some much larger steady state. But yeah, it's that does kind of show their potential is, hey, they have 2.7 million customers and they're only like a fraction, a quarter or so, or even less of your average premium. So yeah,
And then moving a little lower on the income statement, like the gross profit, it
yeah,
seems like they've been crushing it in terms of gross profit, 64 million last quarter, up 109% year over year.
yeah.
And their gross profit margin is expanding rapidly as well. Is there a reason why that's all happening? Is that just because they're finally hitting an inflection where their operating expenses are staying fixed? Or are they making better products and profitability with them? Like, can we expect this trend to continue? What's your kind of take here?
Yeah, it's because they're a lot of their operating expenses are staying fixed, but then their their underwriting and loss ratios have been improving. So you think about you absorb and have like this huge impact of inflation on things and on your book. You cut out those worst customers, you change your rates. Those rates, maybe you change those rates, but then maybe the customer doesn't renew their insurance for 6 months later, and then they renew like their policy and the rates are higher, but now it starts to trickle down. So it takes, I mean, like insurance is kind of like slow like that, and that's just the nature of the sort of regulatory, framework of the industry. But yeah, so that's why you're seeing this, dramatic rise because you're continuing to grow your top line, and then your loss ratios at the same time are improving. So, um, where will the loss ratios end up overall? I don't know. That'd be another question. Like, it's it's hard to say. Like, it's a trade-off between if you have better pricing than anybody else, then your marketing, that growth spend portion that's funneling back to, is going to be more and more effective because people check their rates and say, wow, yeah, I should switch to Lemonade. It's so easy, seamless to switch. And like so it's a trade-off between you could have worse prices, a little bit worse loss ratio, but then you'll be able to grow and take market share faster. So I think they've said it's like their target, it might be around 70% loss ratio. I wouldn't be surprised if they'll be able to do both, like have the best pricing and still, and maybe they'll like have a 65% loss ratio, like a little bit better even than they've said sort of for, 70% kind of as a rough guesstimate. But um, yeah, there's a little bit of loss ratio there too. But
Yeah. And I feel like um what I'm kind of tying this all into is this inflection towards profitability that I'm seeing with Lemonade, where they just posted positive free cash flow. That's starting to look good. Their profitability's kind of been like, I want to say flatlining, but actually decreasing as a percentage of revenue. So I feel
mhm.
like that's the moment where we could get a lot of excitement from Wall Street and for the stock is with this turn to profitability. So are you seeing that too? Is that right around the corner? What's that looking like?
Yeah, absolutely. I mean, they've been saying like, well, I think it's for like 4 years already. They've been saying adjusted EBITDA profitable in 2026 and then GAAP profitable 2027. And I mean, that's how I'm looking at those numbers, looking at that sort of framework, how they're funneling, like that makes the numbers work in my mind. Like that's where we're going to see it. Part of why they're Part of why they're misunderstood is because that the growth spend portion that I was talking about, that's like significant part of your constantly buying or like people's getting your word out and making ads for growth, is they've been ramping up that growth spend portion significantly. Like as COVID and they had like loss ratios were really bad, they really slowed down growth. And of course, they really slowed down the growth spend, other than in certain channels, like they're still growing some. But now, as loss ratios are healthy and pricing is where they want it to be, they're really expanding and growing that growth spend. But people, when they do like quick sort of surface analysis of Lemonade, they say, they don't think about it in like a unit economics perspective. They just think about it as, hey, in Q2, look, like if you look they just look at the P&L, and the P&L is going to subtract all of that investment they're making now in growth spend. But the rewards you're going to get from that are going to happen over like many years, maybe the next 10 years, right? Because you acquired customers, and now those customer base, yeah, some of them are going to churn away, some of them are going to stay with you for the rest of their lives, some of them are going to have like, huge policies one day. So like all of the value of that investment, you see the whole investment now, and but then all the value of that investment is stacking up for the years out into the future. So that makes them look worse now than it really is. Like if they just slowed down the growth spend, their numbers would look better immediately, and it'd be like, oh, they're not growing as fast, but look, the numbers are great. Like, but I actually love it for them is because they're very confident in the cohorts, the dollars they're spending on growth, they're getting. They said it's like an LTV to CAC of 3 or even better. And I've calculated it myself as well based on, the metrics they release. And that's roughly where I'm at, like 3 to 4. I think even as car rolls out, it could go to 5, as you can upsell and cross sell these products in your own customer base, plus looking at customers you're acquiring. So that's kind of why the story's a bit hidden, because you're like aggressively investing in the future, aggressively invest, even in like on an engineering side, you could say you're aggressively investing in the future of this really nimble, like autonomous organization. And if other companies are, you're hurting your P&L every quarter, but those are, as you scale more and more and more, you're going to see all the fruits of that. And same thing with the growth spend. So I think the balance of, based on kind of where I expect their growth spend to be over the next, couple of years to get that 30% top line growth that they're projecting, your IFP growth, that's that makes sense for what they're um, forecasting as adjusted EBITDA profitable next year, and then GAAP. And that I think like I did a video on this, but I think they released their Q1 results, or sorry, Q4 results for this year will probably come in February of 2026. And I I think that like those quarterly results could be a really pivotal. I don't know. I'm not investing advice, but that could be like a slap in the face to the market because we'll get the full 2026 guidance that year. There's no guidance at
Mhm.
all for 2026. Boom, you get the full year guidance, and instead of like a huge adjusted EBITDA loss for the previous year, it might be like, oh, we're gonna have minus 5 million or near break even, right, for this whole year, and that's gonna be like, wait a second, this company's going to become profitable. And then suddenly you look out a couple more years, they're going to become really profitable. Like now the numbers are starting to hit us in the face, kind of. So
Yeah.
that's if I had to predict, I could see like major fireworks around that earnings report. But we'll see. Of course, there's lots of unknowns with that too, or how they even what they guide for. They have a history of being very conservative in their guidance.
Okay,
So
that's good to know.
how
Because
the
I
market
was
reacts to
curious
that.
I was curious about the growth rate. Like we grew 35% last quarter.
Yeah.
How do you think the growth rate trends with revenue and or just kind of like, top
Yeah.
line, enforced premiums, whatever you want to call it. How fast is
Yeah.
the core business really going to grow?
Yeah, like revenues. So so it's a bit confusing because in-force premium, like you talked about, is just like the premiums you have on the book. But then when they give re when they use reinsurance, so they rely on another sort of larger reinsurance body to absorb some of the, you know, downside, sort of massive downside risks. When they give away or cede some of those premiums to the reinsurance company, then those premiums don't count as revenue anymore. It's kind of like backwards because they also, those reinsurance companies help pay some of the claims. So it's like you're at the end of your like gross profit won't change as much, but your revenue can fluctuate a lot. So I wouldn't be surprised over the next, year because they had a major it was earlier this summer. When was it? Like in June or something, July. They had a major change to their reinsurance where they went from 55% of the premiums being ceded to 20% or approximately 20. And so as um as that makes its way through the book, which it will over the next like year or so, or next, few quarters, will like reinsurance or sorry, revenue year over year could grow like probably 75% or more over the next year. So that might even hit people in the face too, like as they see sort of the revenue like guidance for next year. But if you kind of go a layer above that to the in-force premium, I think it was 29% growth last quarter. It was slowed again during COVID. It was like down in the lower 20s or something like that. And I expect that they at their investor day, their goal is 30% or more. And I expect the way I'm modeling it's like low 30s kind of um, from from here. Of course, like there's a balance. You could grow faster and you could spend more on growth in any given quarter, but you don't want to like completely spook the market and your investor base because that makes your P&L look worse. There's also like a diminishing losses of it's a function of, I have this many products in this many markets. There if you can only spend so much on marketing effectively, right? And then every dollar after that's become less and less effective. So there's some factors there, but as they roll out car, like it's gonna be a game changer because car is like as much as I'm excited for pet renters, like they're like 5 billion or so, markets in the US and they are growing, both of them, especially pet. But car is like, $300 billion market. So in terms of your sort of marketing spend and cross-selling, upselling to existing customers, it should be really dramatic as they scale, as they push into car more.
And I'm a big Tesla fan. It's my biggest investment. So I went to Austin, rode the Robotaxi. It was epic. I
Yeah.
mean, that's the biggest thing happening in the car industry is like where car ownership is changing for the self-driving car. So how do you think
Yeah,
about Lemonade's position? It just that worries me is like, oh, our new
for
growth
sure.
angle is like traditional car insurance, which is sure you might outcompete Geico and Progressive, but the whole thing of what car insurance is changing. So
Yeah. Yeah.
how do you make those kind of
It's a
like
great. That's a
Yeah.
great question. And lots people are like, that's probably one of the most common questions or like YouTube comments I see is like, oh, what about car? Like, so definitely worth addressing or at least giving my take. Okay, it's car. So car is like 300 billion, just the US, let alone the whole world, way bigger. Um, and I'm a huge Tesla fan. I mean, I said this before we started recording, but like the biggest, HyperChange, channel fan back in the day. So this really comes full circle for me, and you to like chat
Epic.
about lemonade with you. This is pretty sweet. But so I believe yeah, robotaxis are coming. I believe Tesla's going to be the, by far the biggest leader in that. I think on one hand, it's going to take time to scale. Like there's like whatever it is, 1.5 billion cars in the world. So even if you could make, or even more than that, whatever it is, even if you could be making like, 100 million robo taxis tomorrow, every a year, it's going to take a long time to scale it out. Maybe they're more efficient. Maybe they're 5 times more efficient. So you don't have 1.5, maybe you have 300 million robo taxis, whatever it is. But it's still like, it's going to take time to make those things and scale them out. And some regulation or some, geographies are going to be slower and more conservative in their adoption. So it's going to take some time to roll that out. Um, and then I'm more of the belief that a portion of the market is will still need, there'll be people that'll say, hey, I'm like a carpenter and I have my truck set up just the way I want it. And like, I never need this thing to drive anywhere, like I drive myself, or I can just be the guy taking over monitoring it. So there'd be some poor, or maybe there's like families that have their car seats in the car and they're like, I never want to change, move that around. I don't know what that portion would be. That'd be up for debate, and maybe I'm wrong, and maybe it's going to be 0%. But you might say maybe it's half the miles driven, and maybe it's a third, a quarter, 10%, whatever it is. Say it's a just for like to put some numbers to it. Maybe it's a third, maybe 2/3 of all driven miles go autonomous, like in steady state, and then 1/3 is like people that still would need some kind of more typical insurance like we understand it today for their vehicle. It's like, well, that's still like even in today's market, like $100 billion market for a car in the US then roughly. And then inside of even on the robotaxi side, I go, okay, if people have like a fleet of 100 robotaxis, they might still want insurance for like hail damage or environmental things, maybe vandalism from customers or people, or like just still be some insurance need. There would be like, I don't want a hurricane to come and destroy all my robotaxis, and then I'm like totally wiped out. So it might be a much smaller, amount of premiums that because you're not covering like, the risk that you kill somebody. It's like more like the risk that my windshield gets destroyed, right? So maybe they're like, even if maybe those premiums are 1/10 the premiums of what, maybe they're $2,000 a car now. Now they're $200 a car, or maybe that market that was 200 billion of, leftovers is now 20. It's like the market might still be like, instead of 300, might be like $120 billion. And it's like, well, Lemonade has $150 million. It's like, that's still a ginormous market. Um, and then even, inside of that, you think about like, say there's more niche products for robo taxis or like the needs of covering a robo taxi or whatever it is. And I'd be talking probably more like individual owners that operate fleets than Tesla. I would think like Tesla is probably like, look, we have enough money. If something goes wrong, we're just going to cover it ourselves. Like, but those sort of individual owners and operators, um, you in I think Lemonade's going to be better set up than competitors because those products kind of become less loved. Like the reason insurance companies love insurance like car right now is because it's a big number. You get a lot of premiums for your product, and so you can kind of afford to be less efficient and hide like, hey, we didn't serve, we're like less efficient. All we do for our customer service like plan is just hire more people. Great. We got more people on phones that are helping and emailing people. It's like that's the plan. Like, and that doesn't really scale well if those products become less loved. But for Lemonade, it's like that's perfect. that's the sort of market they're going to dominate in because it's going to be a more tighter competitive market. And the winner, like the stronger, more efficient company is going to even shine brighter. So in that kind of world, I'm like, they could still do that. And then there's other things like you're like, I don't know, maybe we're all going to have autonomous robots or like fleets of them, a farmer is going to own 1,000 robots that are like working his field every day and like he buys insurance on those sort of things or like there's still the market, I think, even if it shrinks in some ways, could like grow or expand in other ways
I
that
like that. Yeah.
we can't even quite understand yet, right? So anyway, that would be my take on that. But it's a
And I
great
like
question.
Lemonade is so nimble with how they roll out new products and their tech stack that
Yeah,
that's why I like them. It's not like this is a bet on car insurance, just like they seem to think they can do really well at that now, so they're going into it. But if you look at their other breakdown of their business with like pet and like they're in all these other things. So I feel like,
yes,
and I hadn't been thinking of the growth of insurance with new things like your Tesla bot fleet in the farm. So
yeah,
I like that angle of like it's not like insurance is over. So on that note though, what do you think about, one of my mantras is invest in the future you believe in. And so I'm always trying to invest in companies that are building a better future. And so that's one thing I've struggled with Lemonade is like trying to get as excited or inspired as like Tesla. Maybe it's just like the fastest, coolest car that drives itself is hard to compete with in terms of fun. But
yeah,
I got this lemonade. This shout out to
yeah,
Javier who got me this lemonade shirt. It's like from the investor day. It says I love insurance or something. Is insurance is awesome or something. Anyway,
yeah, something like that.
but how do you so I'm trying to think about like lemonade as a vision, as a brand that I can get on board for.
Yeah,
How do you think about that with invest in the future you believe in? Like, is insurance, it seems,
yeah,
I don't want to say the B word, but boring.
yeah.
So, how do
No, for
you,
sure.
but maybe boring businesses can be great. But so,
Yeah.
what,
Yeah,
yeah,
yeah. That's, I mean, for one, I love that, like that way of your thinking, like that you, as investors, we are like allocating capital, and this can really like pull forward the future that you want. I think that's super cool. And yeah, anyways, important part of even like your sort of like a life meaning and what you're doing with investing and like how you can shape the world. So super cool. Why do I get excited about Lemonade? Yeah, it's not as exciting as Tesla in terms of like, hey, they could solve climate change and they have like cars, that are like unbelievable vehicles and way safer. Like, it's not that exciting in that way. It is just insurance. But it is exciting because I don't know. There's something like I'm an engineer in my background, and there's something about like I loathe like bureaucracy and like just status quo sort of inefficiency of like, and I think most large companies have like way more processes and things have like way more than people sort of think about or realize. And so if you can build this company that's super efficient and then pass on those savings like more to your customers in terms of better rates, it's like this is a company that could save, for one, make everybody happier, like with a net promoter score that's above 70. And then also, just because of the ease of use is so much better, but then also save like hundreds of millions of people maybe one day, like money, on their insurance. And then also in terms of that, it's like incentivizes, hey, people that are just more conscientious, more careful, more thoughtful people, they're going to have even better rates. And you'll see sort of a larger spectrum between that. So you can, it's like, to me, those are great things. It's like we could be saving hundreds of millions of people money and they could be actually like love and delighted with their insurance product instead of like loathe and hating their insurance product. Like that sort of ties in. I think they don't really push this, but they're like their mission or whatever, some statement Lemonade's thrown is like they want to be the world's most loved insurance company. So then in that sense, it's like you love this. And also we haven't touched on it, but they have part of their framework is the give back. So if you buy insurance from Lemonade, you pick a charity that you would care about from like a list of charities they partner with. And then if you think about all the people in the same charity that you picked for a year, that you become a cohort of customers, and at the end of that year, they'd look at that charity of those customers, and if your loss ratios are low enough, they give a portion of your premiums back to that charity. The idea is like you're doing a social good. You're kind of like tying your hands for them from like a third party to say, hey, like we're not just trying to maximize our loss or profits to the most highest extent, but trying to do good in the world and balance like people not
Hmm.
trying to say, hey, we don't want you to commit fraud or feel like you deserve to gouge us as your insurance company, because if you do, it could hurt the charity that you chose. So, anyways, like there's some
I
social
like
good.
that.
You can debate the give back. Some people get really up in arms about it, like one way or the other. But it's a very like unique, interesting,
Yeah,
thoughtful, once
that's
again, like
cool.
dynamic to the whole thing. So that's I don't know. That's why I'm excited.
I
That's
like
why
the
I can
peace
get
of
excited
mind.
about insurance, and like even your t-shirt, like insurance is awesome, like what does that even mean? But the people at Lemonade, like the staff and people I've interacted with, it's like they really believe that. It's like they're pumped about that vision that they're creating, right? So,
Real, and I like what you said about peace of mind. Like, that's really important to have give people peace of mind when they have insurance and like
yeah,
that's something that makes people's lives a lot better. Um,
totally.
so okay, wait, I got one question from Henry Invest. Shout out to him.
Yeah,
About Lemonade's agentic AI.
right. Yeah, yeah, I
Is
saw
that even
that.
worth discussing, or what's the scheme with that?
I mean, I don't know how much I could like add to it, but I can like Um, I think what he means with that is, well, there's a couple. For one, they're using like LLMs to, serve customers better, even internally, how they manage things, even like phone calls where you answer the phone and it's an AI, and like it can literally make policy level changes from that conversation right on the phone. It's not just like, hey, email, you send me a link to my phone and then I'll do you whatever. But then also, I think it could be referring to Shai, one of the co-founders, has tweeted in the recent months about how they're using. I think he called it loco for like code, that they're really like all of their engineering staff is using a system of where they're not like they're all using this more systemized way of using LLMs for their coding, and also checking and like how they deploy that and like check it over, I guess. And so I don't know if there's like you don't really it's cool to like read those things. I feel like the proof is in the pudding. Like we'll see that in the results or we won't. It's sort of like we'll see that in that operating leverage. Like, those, will it grow at 5% or less, or will it grow more than that because they needed more engineers because it wasn't as efficient as they thought? But it is, yeah, they are trying all those different things. So
Interesting. And this is a good one. I thought that will Lemonade, because they're growing quickly, need to raise more capital to keep up with regulatory requirements? And I guess that's my kind of question in general is like, is Lemonade standing on their own 2 feet, deciding their destiny, or do they need to raise more money to fulfill their business plan?
yeah, they have. It's a great question because it kind of is like with insurance, there's also sort of a limit on how fast you could grow your top line, because for all the premiums you have, there's a certain portion of cash you have to have, a minimum you'd have to have set aside in case there was like a massive disaster. So if you're not profitable and you just grow fast, like max profit growth, there would be some limit where you're like, shoot, we actually need more capital before we can become profitable, and then you can scale and grow that. It's my own math and understanding on this is that they're going to be fine. That because they're becoming profitable next year, or like on adjusted EBITDA at least next year, and then the year after, we're going to start to see, even though they're still growing their top line like aggressively, the ship's going to sort of pivot, and you'll see the profits start to come in, and then that will be able to grow faster than their sort of surplus requirements would grow. But it's yeah, it's a great question, and in some ways, like people don't understand insurance that they just kind of think like, oh, why can't they just like deploy everywhere and grow everywhere? It's like, well, the regulators wouldn't even allow you to do that because they'd say, well, you're taking on way too much risk. Like, how are you gonna, what if something terrible goes wrong and, there's whatever,
Mm.
like, and you have to pay out way more claims than you expected for something, right? So,
That's an
um,
interesting angle because it shows why Lemonade has perhaps been more disciplined in growth. And it's like, well, why aren't they growing faster? That's a good reason to like think through.
yeah, for
Um,
sure.
well, this has been very enlightening. I gotta say, I'm, I'm a little, I have a little bit of FOMO to buy a little more. I gotta say.
Yeah. Fair enough.
I do like Lemonade. I feel like there's a lot of potential here. I'd
Yeah.
almost be curious to learn more about how they're like dominating pet and renters insurance because I feel like those are two markets they could
Yeah.
really crush it with.
Hmm.
Car, big, but I'm less hyped on it, but I feel like they could make a huge amount of money. Plus, maybe there's a weird window where everybody's overpriced insurance because cars are actually super safe for 10 years, more than people think because of more
Right.
robotaxis on the road and more
Right.
active driving features. So there's like a 10-year window of like car insurance companies making huge profits. Just
True.
a theory to throw out there. But
That could be possible. Yeah.
but yeah, so I'm curious to see what their next line item is.
Hmm.
But part of me feels like they're at a really interesting moment where they've done all the groundwork to set up what could be a very profitable company, and now the market's kind of being like, wait, like Lemonade isn't just this like sizzle AI play. Like they're actually going to be using AI to be like the most profitable insurance company, and that's going to do a whole re-rating. And I think that's why the stock's been ripping.
Hmm.
There's a lot of shorts that are trying to spread hater comments about Lemonade, which I think is funny.
Yeah.
But clearly they're onto something here. So I'm super appreciative of you coming on the show. Give me a little
Yeah.
more info, taking the time, the legendary paper bag investor who's like the lemonade guy. So thank you so much. It was super fun to do this.
Super. So thank you so much for the invite, and I'm glad you're at least interested. And like I said earlier, like huge HyperChange, huge Galley fan. So this is very full circle for me, and I feel like even though the stock has ripped, I'm still like we're still at so early in my. I'm like this is 4
Wow.
billion. Like just like But you look at Progressive, they're like a $150 billion company, and you look at the stock chart, and it's just like a penny stock that, just went, just curved straight up. It's like, why can't, if Lemonade does everything better than them, like, why can't they be 400 billion one day or even $1 trillion like one day? Like, you look out enough years, right? Um, we don't know that for sure, but I feel like the upside of them at least being successful and being like a $40 billion company in my mind is super likely. And it's like even the 400 billion, you look out further, it's like, yeah, you don't know with as much certainty, but it's in my mind like it's much more probable than people realize.
So
So
are you holding more Tesla stock or Lemonade stock? Like is Lemonade your
I'm
biggest holding right now?
Lemonade is, yeah. I mean, it partly because
Wow.
it
I
did
like that.
so
Putting the
well.
money where your mouth is,
It
where your
did
bag
so
is.
well. It did so well, like because I bought. I mean, I followed it for like 5 years, but I bought most of the shares in the teens because it was like 2 years. It was in the teens, just like in the dumps, and I'm like, this it's worth $100 a share. Like we're just banging the table, like. So we did, yeah, I did well on those, of course, those purchases, but I still think it's like. Yeah, I think it's like I'm like 70% lemonade, 25% Tesla, 5%, some other little things, but or exploratory things, but yeah. So,
Gotcha. Awesome.
yeah,
Well, thank you so much, Paper Bag Master. Really appreciate it. Everyone go check out his channel, give him a follow, and yeah, maybe we'll have you on again soon to ski more lemonade.
that'd be great. Thanks so much.